They didn't ban you from trading silver. They didn't change the law. They didn't announce a shutdown. But overnight, they made it almost impossible for you to participate. And while most people were asleep, a single number quietly changed everything. 19 to 52,000. Not the price of silver, set the price of access. A barrier so high it filters who is allowed to stay in the game and who is quietly forced out. On the surface, silver still trades normally, but beneath that screen price, a different market is forming, one where paper promises and physical reality are no longer aligned. And when markets split like this, history shows the consequences are never small. And the question is not if something breaks, the question is who is trapped when it does. Welcome to Boring Currency Index. If you're watching this and you've lived through market cycles, inflation scares, policy surprises, then you already know this lesson is worth staying for. And do us a favor, subscribe like you would advise a younger version of yourself, slowly, wisely, and before it's too late. And tell us in the comments, where in the world are you watching this from? They did not announce a ban. They did not pass a new law. They did not shut down the silver market. Instead, they changed one number. That number was $52,000. And for most people watching silver prices on a screen, nothing seemed different. The charts still moved. The headlines still talked about supply and demand. The price still looked normal. But beneath the surface, a quiet structural shift had taken place, one that fundamentally changed who could participate and who could not. In futures markets, a margin requirement is the minimum cash needed to hold a position. It is not the cost of buying silver. It is the cost of staying in the game. When that number suddenly jumps, the rules of access change immediately. N just weeks earlier, holding a silver futures contract required roughly $20,000. Then it moved to $25,000, then $32,500. And now, almost without warning, it stood near $52,000, more than double in less than a month. This was not gradual, it was abrupt, and timing matters. Margin increases are often described as risk management. That is the official explanation. But experienced market observers know that timing tells the real story. These changes did not happen during a collapse or panic. They happened while silver prices were rising and long positions were profitable. That detail is critical. When margins rise during price strength, the impact is not evenly shared. Large institutions can absorb higher requirements. They have access to deep capital pools. Smaller traders do not. Entrepreneurs, independent investors, and small funds suddenly face a hard choice: add large amounts of cash or exit the position. In practice, many are forced out. This is how access is controlled without public debate. No one is told they are not allowed to participate. They are simply priced out. A standard silver futures contract controls 5,000 ounces of silver. At current prices, that represents over $500,000 in exposure. Requiring nearly $52,000 just to maintain that position creates a high barrier by design. It narrows the field to those already well capitalized. History shows this pattern clearly. When markets become unstable, rule changes often appear under the language of stability. But stability for the system does not always mean fairness for participants. This moment marked more than a technical adjustment. It marked a shift in control. Silver was no longer just a commodity moving on price. It had become a gate-kept market, where participation itself carried a steep price. And when access becomes expensive, outcomes tend to favor those who helped set the rules. They noticed something strange before most people did. The price of silver looked calm on trading screens, yet buyers in the real world were acting as if supply was running thin. This was not speculation, it was behavior. And behavior, in markets, often speaks louder than headlines. On paper, silver traded at a familiar price. Futures contracts changed hands in large volumes, creating the impression of deep liquidity. But outside those screens, in physical markets, a different signal was emerging. Buyers who wanted actual metal, not contracts, not promises, were paying noticeably more. This gap matters. In a healthy market, price differences do not last. If silver is cheaper in one place and more expensive in another, traders normally step in, buy low, sell high, and close the gap. That process is called arbitrage, and it keeps markets honest. When arbitrage fails, it usually means something is broken. Physical silver began trading at higher prices in multiple regions at the same time. Not in one city, not for one day. Across continents, buyers were willing to pay premiums that did not quickly disappear. This suggested more than temporary demand. It pointed to a trust issue. Paper markets rely on confidence. Participants assume contracts can be settled smoothly and metal will be available if needed. But when buyers start paying extra to secure physical silver immediately, it signals doubt. They are no longer satisfied with future delivery or paper exposure. They want certainty. This is where price stops being just a number. It becomes a message. When the screen price stays low while physical prices rise, it tells observers that the quoted price no longer reflects real availability. The market is still functioning, but it is no longer aligned. What is traded easily is not what is scarce. Professionals recognize this pattern. They call it a breakdown in price discovery. The price still exists, but it no longer performs its main job, telling the truth about supply and demand. For business leaders and investors, this creates risk. Decisions based on screen prices assume those prices are reliable. When they are not, models fail. Hedging strategies weaken, contracts protect exposure on paper but not access to real assets. This is how two markets begin to form. One is liquid, fast, and abstract. The other is slower, physical, and increasingly expensive. Over time, attention shifts. The market that controls supply gains influence. The market that controls contracts loses authority. At this stage, the silver market was no longer unified. It was divided. And when markets divide, the side tied to reality eventually sets the terms. Something unusual is happening in the silver market, and it's not just about the price. Futures traders almost never take physical delivery of the metal. They just trade the paper contracts. The whole system relies on this. But that's changing. We're seeing a huge spike in requests for actual physical silver, even during normally quiet months. This signals a real sense of urgency. At the same time, the amount of silver available for delivery in exchange vaults, known as registered inventory, is dropping fast. Think of it like a bank run, but for silver. When the amount of metal ready to be delivered shrinks this quickly, it puts serious pressure on the system. Even the big players, who usually prefer cash, are now demanding physical bars. This adds cost and hassle. So when they do it, it means they're worried about future availability. They're grabbing the metal now while they still can. This isn't just regular trading, it's a major shift. Thanks for watching, and be sure to subscribe for more updates. This pressure exposed a deeper structural imbalance. The futures market operates on leverage. Many contracts exist for every ounce of physical silver. This works only when delivery demand remains low. Even a small increase in physical claims can strain the system. As delivery requests rise, risk shifts. It moves from price risk to fulfillment risk. The question is no longer what is silver worth, Mike's, but can silver be delivered? For businesses that rely on predictable supply chains, this distinction is critical. The contract protects price exposure, not physical access. When access becomes uncertain, contracts lose part of their value. History shows that commodity systems become unstable when delivery stress builds quietly. The warning signs rarely appear as sudden failures. They show up as inventory declines, abnormal settlement behavior, and growing caution among large participants. By the time these signals become obvious to everyone, options are limited. At this stage, silver was no longer under pressure because of speculation. It was under pressure because of demand for the real asset. And systems built on leverage are most vulnerable when reality is requested all at once. This was the point where surface stability began to hide deeper strain. And once strain reaches this level, control becomes increasingly difficult to maintain. They understood that markets are not controlled only by prices, they are controlled by rules, and among those rules, margin requirements are some of the most powerful. A margin rule does not tell anyone what to buy or sell. It simply decides who can afford to stay. When margins rise sharply, participation shrinks. This is not accidental, it is mechanical. The $52,000 silver margin acted as a filter. It did not affect everyone equally. Large institutions could meet the requirement with little disruption. They manage capital across many desks and can move cash quickly. Smaller participants could not. For them, the increase was not an inconvenience. It was a wall. When traders cannot meet margin calls, they must close positions. It does not matter whether their view is correct or whether the trade would be profitable in the long run. The position is closed by force. This creates selling pressure that has nothing to do with fundamentals. This is why margin changes matter more than headlines. The situation became more restrictive when margins shifted from fixed amounts to percentages. Under a percentage-based system, margins rise automatically as prices rise. In a growing market, this creates constant pressure on long positions. The higher the price goes, the more cash is required just to hold the same exposure. The structure discourages persistence. It rewards size and liquidity, not conviction or accuracy. From a system perspective, this mechanism slows price acceleration. It also protects those who are exposed on the opposite side. Forced selling gives them opportunities to reduce risk under controlled conditions. This approach has been used before in commodity markets. It is rarely described as intervention. It is presented as stability management. But the effect is clear. Control shifts toward those who can endure repeated rule changes. For entrepreneurs and business leaders, the lesson is structural. Markets are not neutral environments. They are frameworks designed by institutions with specific priorities. Understanding those frameworks is as important as understanding supply and demand. This is why attention began to shift away from paper exposure. Physical ownership does not require margin. It does not face forced liquidation. It does not change rules overnight. It exists outside the mechanism designed to manage participation. As margins rose and delivery pressure increased, the contrast became sharper. One system became more complex and restrictive. The other remained simple and direct. At this point, the silver market was no longer just a place to trade. It was a test of positioning. Those inside the rule-based structure faced increasing constraints. Those outside were unaffected. When control tools become visible, it often means they are being used heavily. And when that happens, it usually signals that the system is under stress, not strength.